It's an absolute privilege to be here in Singapore to discuss the Australian market, something that's been close to my heart for well over 3 decades now, and share with you some of my experiences and my current observations, but also to give you, I'm here to give you the understanding of some of the drivers for markets in general, but especially the Australian market, so you can identify these trends yourself and make up your own mind whether you want to participate in this market and participate in some of the stocks that we have recommended. You're blessed here in Singapore with a very good range of advisors who will give you a lot of detail about the mechanics of trading. We heard a little bit about that this morning from Tom, but also managing your account and then entering a new market like Australia if you're not there already. So it's important that we act as a big team here at PhillipCapital, that different people are very important in this process, and I am from research. I'm here about giving raw ideas, but your advisor can help tailor things to your exact needs, and it's extremely important that we act as a team for mutual benefit. And you'll see in my philosophy the way I approach this. So again, it is a privilege to be here today. A year ago, I was made head of Australian research in PhillipCapital, and we're in a development process. I'll just bring your attention to the whiteboard, which is a map of Australia, and Australia is made up of 5 offices in 5 different states, and we have a variety of different offerings which include retail stockbroking, institutional stockbroking. We do FX derivatives as well, and we're expanding into international ourselves. So there's a lot of offering there, and all from 79 people, but we're a growing place. So this is Australia, and we're on the move. So we're still young in our evolution because PhillipCapital only became the majority owner of our organisation only about 1.5 years ago. So for me, this is an exciting time to be part of this development process. So I've got a couple of little pictures here, and I'll explain them a little bit further. But we're going to go on a journey to Australia, but Australia is part of the global picture, and I'm going to give you a roadmap, and that's a little sneak preview of my little map here. So I'll move on. Next slide. On the agenda today, there's a lot of points there, and I'll try and be brief in the first 2 points, which is PhillipCapital profile. We've got already a little bit of an idea of where they're operating, and our research philosophy, the way that we go about that. If there's any questions, I'll take them after this point. And then we're going to go on our little drive, right? We're going to look at the valuation drivers that push our market around. Some of these lessons are available for all international markets, but some of them are also particular to the Australian market. We are not just about stock picking, you know, this is a good punt, this is not. We're about providing a much fuller service than that, and it's about creating model portfolios that become like a blueprint for you to be able to build a portfolio if you want to be exposed to, say, the Australian market. And with your advisor, working together, you can work out your own risk profiles, your own number of stocks that you want to be exposed to, and diversification, and yield versus growth. These are important characteristics. Again, this is not just about research. This is about research, working with your advisor and yourself to get something that's specific for your needs. So that's the model portfolio. We're going to talk about some of the interesting small capitalization stocks and contrarian stocks. These are high risk, but potentially higher potential. And I'll give you a little bit more on the model portfolio. Thank you. So I've already talked about the profile of PhillipCapital. This is globally. This is multiple products, quality products that can fit your needs. And you probably know a lot more about PhillipCapital than I do, but it's been around for a long time. And in Australia, the 79 staff that we've talked about, I've talked about the complex offering that we have, and we're building our platforms to make it even easier for you to be able to participate in these markets. Thank you. Sort of like PhillipCapital's everywhere, that almost matters in the financial world. So I'm glad that Australia is integrating gradually into this network even more. And I've had the pleasure of spending a lot more time looking to integrate into the international research operations of PhillipCapital as one instance of our development process of Australia going places. Thank you. Right, the sort of products that that my team produces, we produce this monthly model portfolio report, and I hope that that can become available to you as our latest offering. And also we also do individual company reports for things that are updating or stocks that we think could be worthy of inclusion in your own personal portfolios. And then sometimes we look at thematic sector reports. We did an IT report, for example, retail trade one. Sometimes I update on the resources side of things. Now, the important thing is we have a small team, but we both come from what we call, the sell side, which is the stockbroking side. I've had experience with the NatWest Group in Australia, then became Citi or Citigroup, and also with the antecedent organisation that PhillipCapital took over called Austock. But most of my time has been on the buy side, and that is running the New South Wales pension system for Australian equities. That's a multi-billion-dollar account, and I did that for a number of years, even through the privatisation process of that. So that was not a little business. We privatised that for $1/3 of $1 billion for our team's work there. So that was quite good. So I'll move on to this, and this is our team. That's me here with the experience. My key partner is Ken Wagner, who's also had buy-side experience with Challenger Group in Australia and Affinity Partners, but also been on the sell side with Wilson HTM, ANZ Securities in the previous time. We are privileged in PhillipCapital because one of the big problems about research is that you often have corporate relationships which sometimes they give you conflicts of interest. We have a corporate capabilities partner called PAC Partners. We were all one team. This is separated out. They take those conflict of interests away from us. Yet we've got access to their individual expertise, which span, he's an ex-geologist, for example. He's ex-engineer, and he's also an accountant. So we've all got those expertise available to us as well. So I'd just like to move on to what drives me, why am I in research? I am in research for one reason and one reason only, and that is to help allocate capital more wisely in the world in general and for specific clients in detail. That is a socially useful thing that I believe, because if we allocate capital wisely, we have less waste in the world. With less waste in the world, there's more to share with everybody. So it's a philosophical thing, but it's extremely important. And by everybody trying to allocate capital wisely, the world will be in a better place, and I will dare say you will be richer. So this is a happy coincidence. But to get from that high goal, how do you do it? Well, you need a theory, and our theory is that equity pricing, that what happens to equity prices, is driven by lots of these important factors that drive the equity market, that drive stock prices. So that's our theory, and our process is to capture that theory by looking at the economies, an economy like Singapore or Australia in our case. We look at subsectors, the telecom sector or the resource sector, for example, and individual stocks. What are the important factors or drivers that will lead to these things? Valuation. These are the important drivers for the pricing of equities. Liquidity, cash rates, portfolio preference, what do people want? And of course, movements across borders. And then finally, earnings itself. This is the thing that does the heavy lifting. Who makes the profits? What determines profits? And from that, we create the various products like the monthly report, the stock reports, and they're based upon not intangible things. They're based upon cash flow. Cash flow is everything. Cash flow is the thing that is the basis that these other influences come upon to give you a final value and price. And when there's something different there, there's the opportunity for you to make money. So now we're going to start our journey here, and here's my map. We've got a compass, and I'm going to talk about where we are in the Australian market over a long period of time. And this actually spans my entire career. In fact, I go back a little bit further than that. So I know every one of these little bumps personally. Some cost me money, some haven't, but hopefully I've learned a few lessons. And so we're going to look at it from a returns perspective and also a risk perspective. And I've represented that by the volatility index. So first, over the long term, the Australian equity market, and I've looked at the All Ordinaries Index because it's just got a longer time span. This goes back to the 1950s, in fact, even longer, has risen at about 11% per annum if you include dividends in this calculation. So it's the price of the index and dividends. But so where are we? We're actually, since the GFC, we're actually below that trend. So there's is there an opportunity there or not? Another way to look at where you are from a returns perspective is to look at the annual returns. I find these quite informative. And in the last 2 years, there have been positive returns after a negative year. In fact, since the GFC, we've had 2 times of negative performances. So it's been a very volatile time, as you would probably be aware. But to get through all of that noise, I like to look at returns on a 3-year rolling basis. And what happens is we are now at one of those junctures where you could go down or up. And why do I say that? About a week and a half ago, the cumulative returns over a 3-year basis was about 58%. When the market gets to about 55 to 60%, you often get periods of consolidation, sideways movements, or even pullback in the Australian market. But I'm also informed by we're below trend. So what we're trying to determine today is to look at the various drivers that will determine whether there's actually going to be sideways or down or moving up, and the price, the prize there is going back up here. Going back up there would add about 6 to 7% of per annum returns over the next couple of years. So it's a prize worth having. So I believe to look at this risk factor, there's one thing that you should be looking at, not geopolitical factors because they come and go. They're all about volatility. It's about whether growth in the world and growth in Australia is going to stagnate or not. If growth stagnates, then we're probably going to have a period where these red bars are going to be small for a year or two, or even negative. Or if we do over the next, not the next 3 months, I believe, but over the next 9 to 12 months, have a re-acceleration of growth in Australia, and a continuation of the acceleration of growth in the United States and possibly other places, then we could have a good finish to this financial year. I'll get into that decision point, so you can see the difference in my thinking, which will drive returns here. Now, volatility. When stock markets are very comfortable about things, usually there are not many bargains around. When there's a lot of fear around, prices fall, there's usually a lot of bargains. A couple of weeks ago, the volatility index of the Australian ASX top 200 stocks and also the United States volatility index was at multi-year lows. In fact, they are all-time lows. And guess what? Both of our markets were at recent highs. So not many bargains. However, that started to kick up. And in fact, even since I've written this, I've been on the go myself in the last few days, the market's volatility has been rising and share markets have been coming back. So you might think this is a bad thing. I think it's actually a good thing. So when there's too much comfort, there's complacency, people are not prepared, share prices are poised for the first bad news to come down. So there's been a bit of complacency. What is one of the triggers for this? I will go into the drivers of the Australian market shortly, but the key one, if you take nothing away from this talk other than this, is that the equity market is driven by other big markets. And the big markets are the fixed interest markets, that's the debt markets, and also currency markets. And this is the big one. You should be concentrating your minds on what happens to the process of US interest rates. And if that goes up, you're going to get something that's very important that's going to happen. Individual countries will perform quite differently in their equity markets. Individual sectors will perform quite differently in each of their the ways that they will perform. What that means is that volatility in the stock market will go up. Now, I'm a trustee on some investment funds that invest for other people, and what have I been buying through June, July, August? I've been buying one thing. I've been buying volatility because it's been the cheapest financial asset in the world, basically, on it. And that's because you've got these multi-year lows. Volatility is cheap, and this is a complex area. It's not something I'm going to talk a lot about, but you can incorporate volatility into your portfolios to give you portfolio insurance or an active position to make money. And this is something that you should be talking to your advisors, because volatility's kicked up here, but in the past, it's gone from 10% to 40%. And at a time when usually the markets are in a little bit of strife. So you can make money in falling markets, or you can help protect your positions in stocks that are perfectly good, but going to have a temporary time of sleepiness, sideways movements, or even pullback. But you want to be exposed to those long-term benefits. So volatility is cheap, still cheap. It should be in your portfolio. Talk to your advisor. So I'll now move on to what we're going on. We've got our roadmap. We know where we are in the Australian market. We know that there's a little bit of complacency, but a bit less this week than 3 weeks ago. Thank goodness. That's the opportunity. And what are the big drivers for the market? So they are going to be what I call valuation, cost of capital, liquidity, the cost of money, and growth. That's profit growth drivers. So valuation. This I'm going to look at this on the basis of what I think these scores are for the next 3 months and how they might change over the next 12 months. And what we're finding is that in the next 3 months, roughly what we've had over the last 12 to 18 months will continue, but waning as we get a rotation. So valuation is going to go from highly supportive to the stock market to potentially a headwind. So valuations will come down. I'll explain that more in a moment. Liquidity, US monetary policy has been very stimulatory in the past, becoming neutral now and potentially going negative. But other factors like European markets, Japanese markets, Chinese monetary policy, which has been negative, could neutralise because they probably got to. And I'll show you a chart on that in a moment, later. But there are other portfolio preference reasons where dividends are still way above cash rates. You're still going to be supportive. So we think liquidity is going to be supportive to the stock market. And then finally, the growth drivers, the things that drive profit growth, they've been mildly negative. And they are negative now, and they're probably going to be negative for at least the next 3 months. But they're probably going to be slightly positive as we're going into 2015. This is a big change. This is a big change. This will remain supportive, particularly in the Australian market, because our monetary policy is, unlike many other cycles, is years behind the United States. At least a year, possibly 18 months. It will be influenced, but it is behind. Our monetary policy is something that our market participants have to learn about more, because we usually just follow the United States blindly. So, and in the past, it's always been a good thing to do. So there are a lot of things here, but I just want to talk about this. This is very important, and it's quite technical. So I'm going to move over to this to the whiteboard here. Hopefully this will be good enough to get here. Right. Now, this is the first element. Oh, thank you very much. The valuation element. It's about the cost of capital. And the first bit is when you're trying to work out the discount rate, what makes up effectively the valuation for equities, the first thing you look at is the competing market, which is bonds. And what we've found is long-term bond rates used to be 5 or 6%, but you know they've fallen to 3%. And many markets they're much lower than that, 2% or even lower. So we've had a big change in the bond market. The next part of the valuation is what's called the equity risk premium. Equities are much more volatile than bonds, so you need to have a better return for that risk. So equity risk premiums of 4 to 6% used to be common when I was a bit younger, but they've compressed to 2 and 3%. So there's been a change there. And when you're looking at an individual stock, there might be some other factors that are maybe a bit more risky. A mining stock might have extra need for return because it's highly volatile. A telecom stock may be less volatile. So if we looked at this, and this is just indicative, but what I'm going to describe to you is extremely important because it affects value from valuation, and also the driver is from the central banks and liquidity. If we had a cost of equity of 10% before, it at the moment is being priced in the market at 7%. You'll say, oh, that's good. Actually, it's not. And I tell you why. If you are a buyer of an equity, if you invert that in rough terms, there are some other complications. This is an approximation, but the price earnings ratio for that sort of asset might be about 10. But if you've got a discount rate which is much smaller, the price that you're paying for the same thing is 43% higher. So if you're a buyer, you're paying more for that financial asset for the same rewards. And that's why the cost of equity has been driving up, as it's been going down, it's been driving up the price of assets around the world. Australia is no exception. You'll be amazed at how closely Australia has tracked the world. So this is an important concept. when I talk about these factors turning, I'm talking about this starting to go up. That is the cost of equity going up. And when that goes up, prices of equities will go down, but not all equities. And that is what the important thing is when you're positioning yourself for the next phase of equity market pricing and growth. Let's look at some of these factors in a little bit more detail. And first of all, valuation. Now, valuations, you know, as I talked about, this is the classic one. So I'd like to characterize this as a classic Maserati vehicle, right? It's a nice racing car. I think you've got the Grand Prix coming up soon. So this is, for me, as an analyst, this is where I start in my looking at the discount rate. And what's been those drivers? As I mentioned, the bond market. So if I look at the US market, which is the red line, it's been coming down, 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 down. The Australian bond market, it's also been coming down, down, down. The difference between the two is the green line, and you can see that we've had a healthy premium to the United States, and it's one of the reasons why the Australian dollar has been so strong. People want to get that extra return for their dollars as opposed to buying US treasuries, indeed European treasuries, certainly Japanese bonds. So people want to be exposed to that. However, the green line is starting to come down. So the difference between the two is compressing. The need to buy Australian bonds from at least an American destination is less. Now, the next week, Janet Yellen will be talking about policy and whether this line is going to go up a lot or not, possibly might be triggered by her statements. Possible. But we believe that the bull market in bonds is likely to at least go sideways or go up if the US manufacturing and services sector, which has lifted a little bit, continues to lift because policy is extreme. In Australia, we've had CPI, which is the red line here, go up. Real rates are very low. So what that means is for local investors, there's not much use in holding cash. It's low returns. In fact, after tax, you've got negative returns. So you're going to go into the stock market to find higher yields, and those yields are there. All this means from a valuation perspective, people are driven into the stock market. We talked about this equity risk premium, and I'll just highlight that on the screen. That's this bit here, and that's the stock, individual stock premium. That has been coming down over time, so that's been supportive. We've already gone through that point. But that demonstrates over time that this has been coming down. Now, global PEs, that's price earnings ratios, are represented in the red. And what you've seen over the last couple of years is they've gone from, well, funny, around about 10, and they're around about 15 now. The Australian stock market, I mean, it's hard to see it. It's the blue line. It's almost identical. So this is not an Australian event alone. This is a global event. So there's no difference. There's no advantage of Australia over the world as an average. There might be differences of Australia over particular markets. So, but the thing that I'm calling is the race is over on this necessarily going up. It might go up a little bit more, but you should not rely upon the price of earnings going up in future to give you your portfolio returns. You've got to be much more selective about that. It's the better company, it's the better stock that's going to be the one that outperforms, not necessarily all stocks outperforming like that re-rating. That's a very important point. More on so yep, that's the end of that one. Now we'll move on to those liquidity drivers, and look, I'm going to give you the ultimate invasion of your privacy has occurred in recent years, and it's a very disturbing one for me as a libertarian. But in a transaction, when you make a bargain, it's like a deal. It's like a holy deal that you do between two people. There are not two people. There are three people involved, right? And the third person is the central banks of the world, who have now changed the price of money to such an extreme extent. Nobody would think that interest rates of zero, or in Europe's case, negative, are fair for anybody, right? But they have their reasons for doing this. So we live in the real world. The real world is low interest rates. These are the policy rates of United States, Eurozone, and Japan's down there. So we're in a big monetary experiment, and there are dangers involved here. But for the moment, the Euro area, Japan, and most other areas in Australia were on relatively easy money. The United States, though, this is now potentially going to change. And the question is, does it change next month, next quarter, the June quarter of next year, or the June quarter of 2016? That's an important question, because as you take away liquidity, cheap money for free, basically, that's going to change with the value of this liquidity driver, money going into the market. I'll tell you something else. A lot of you are probably involved in real businesses, you know, construction, making in the manufacturing business and service businesses, in the medical profession and that sort of thing. That's, to me, the real sector. The financial sector is advantaged over every one of you, because when policies change like that, who are the first recipients of this free money? It's the financial sector. And what happens is the price of financial assets like stocks, like bonds, goes up first. So that when the real sector gets actually better and they start demanding the money, sometimes financial assets go sideways or even down. So good news for the equity market at the moment is, US growing okay, but not super strong. You'd think super strong is good for the US stock market. It's, for the moment, from a valuation and a liquidity driver perspective, it's actually not so positive. So that's the liquidity driver. So this is experimental and it's pretty racy, just like this F1 driver here. So just watch out for liquidity. All right. Now the other driver is that there is money still coming into the Australian market, both from people taking cash balances, putting it into the stock market, and also overseas people buying it. And the reason is, that the blue line is Australian dividend yields, and this is global dividend yields. So there is a big difference in this one, and Australian market can attract this extra support. And because of franking, there's a tax paid element in a lot of it for local people. And depending upon your jurisdiction, you can get withholding tax relief as well. But please, you need to be advised by your tax advisor, and also to talk to your PhillipCapital advisor as well. So that's still positive. Now, as we move to the earnings driver, look, there's a bit of a problem here. Earnings driver, as I said, is the heavy lifter. This is the real sector producing real profits and real things. And, you know, trucks lift good things, not like F1 type fast racing cars, but it's blowing a bit of smoke. So this is the negative. In the Australian economy, we did have a good lift in the March quarter GDP. This is gross domestic product, but it's come back down in the latest figures of the June quarter. So from March to June, we've had a fall. And this is the actual hours worked, which is actually an important indicator as well. And hours worked is not growing very much at the moment. I anticipate that we'll have another quarter of at least pretty tepid growth in Australia, very, very slow growth. So if growth isn't working for you, can companies get joy from pricing? Well, unfortunately, the answer to that is in the short term, no. This, if I look at these, this open dot is from the whole year, financial year, and this is the latest quarter. If it moves to the left, you've got less pricing power. Almost every single one of these dots meant you've got less pricing power. So prices aren't going up for companies. What about disposable income? Are people earning more? Well, the answer to that is no. Australia's real disposable net income is actually very low at the moment. In fact, on a per capita basis, it's actually negative, but it's actually below GDP. And the reason for that is that we've had the terms of trade start to come down. You've heard of resource prices falling. It affects the income. So all this paints a pretty negative picture. But what it does mean is that from a liquidity point of view, interest rate point of view, the Australian interest rates aren't going up. So that's going to remain supportive. You're going to have cheap money for an extended period of time, and that will go into next year, even with possibly US rates being improved, because the local economy is not buoyant, but earnings are going to be a little bit tough to find. So we've got to dig a little bit harder for the companies that can find good earnings, and we're going to go to some special places to locate that, I promise you. So so one of those special places is some of the countries involved here. So Australians companies are not just exposed to the Australian market, but many have got operations overseas as well, and different types of operations. So let's look at this. On the right-hand side, we're looking at manufacturing purchases managing index. These are the latest figures, and I've organised them on the basis of the highest number here on August. US is on top. Manufacturing is expanding at the biggest rate, given that 50 is nothing happens. Below 50, you're actually contracting. So that's going, not only is it expanding, but it's expanding at an expanding rate, an accelerating rate. So US, Taiwan, Canada, even the globe is on a positive move there. That's with India. Yeah, it's okay. It's still expanding. Japan, still expanding. Germany, okay. Russia, I'm surprised that's not bigger negative, but it was bigger negative early in the year. Eurozone, slipping a bit. China, slipping. Australia, down at the bottom of the pack. Part of it is because we're deindustrializing some of the heavy industry, and that will pass quite quickly. And it's one of the reasons why I think the numbers that you're seeing right now are temporary and that they will turn. We've had some aluminium smelters close, and also the car industry is progressively closing down. Now, to me, this is a good thing. The reason why is I go back to this idea of allocation of capital. You can do lots of things with your money. You can give subsidies to car makers, or you could give better education to our people so that they can use their brains to create the next industries. I know what I would choose. That different ones might have different payoffs and different pain for different people, of course, and that's a political issue. But we remember it's about allocation. And we're going through, I think this is a cleansing so that we're going to do the things that we do well. Some of the stocks that I show you are the things that we do well that often people don't even know that we do well. So that's the first point. The world is expanding from a manufacturing perspective. And unfortunately, this is very tight. There's also global services. In fact, services is doing a bit better than manufacturing, which is that little line underneath there. So that has important implications when you invest, not just in Australia. It's about possibly you want to be involved with the United States, possibly you want to be involved in US manufacturing or things that service that, but you want to be involved in global services. as opposed to maybe manufacturing on the whole, because that's what's doing well now and is likely to do better in the next little while. So the world's not such a bad place. To me, the world's a happy place. Now, one of the yeah, it is. It's never been better. Even with my former friend, he's off my Facebook page now, Mr. Putin. Anyway, so what we find for Australia, we have another headwind, but this is an opportunity for the world as well. And with commodity prices coming down, this is an index that I've used for many years and I've created myself. But this is in US dollars with an index going back to 2000 as at 100, and you'll see that the commodity prices that matter to Australia went to a very high number, 500. So that's up from 100 to 500 by just as China reflated after the GFC in December 2011. And since then, it's been down, 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 down. Now, the secret of Australian policy is a very open policy, and the Australian dollar has been one of those shock absorbers that when things are bad, boom, the dollar comes down. The Australian dollar prices don't tend to fall as much. So this line is the blue line. That's that same index in Australian dollar terms. It's a lot less volatile. So the pay that the miner gets is less volatile than the US dollar would commodity price in general. But this has not occurred this time because of these policies of central banks that have meant that Australian high interest rates have attracted a lot of funds and kept the Australian dollar, which is the green line, much higher. Last year we had a big play on the Australian dollar saying it's going to crack, it's going to crack. It took a few extra months, and when it did crack, it went down. And the reason for that was the commodity prices were coming down. Now we're at the same juncture. In the last month or two, we've been calling you should be exposed to Australian companies with overseas earnings, because the Australian dollar is now at an unsustainable rate because this is coming down. And when I did this only at the beginning of this week, the Australian dollar was 93 cents. It's 90.25. So when it comes down in a thud. I believe longer term that the Australian dollar about 85 to 83 cents is more appropriate. I've also only got a couple of half years of low commodity prices before I think that the world itself will start to demand more of our resources, and some supply will be taken off, a bit more equilibrium, and we'll get a slightly higher price. So this is the opportunity to come. But we're talking about at least a year out on Australian commodity prices. So earnings for Australia at the moment are negative, but there are some what I would call hopeful signs that will turn around that earnings driver. So the tip is you want to be exposed to those things that have got earnings growth in time, and you pick up the highest quality ones now when there's a little bit of angst in the market. But if you've got something that's only reliant upon the valuation effect, that cost of capital thing, which could go in reverse, if it starts going back this way, the PE start falling, you're more than likely not going to make money. You're more than likely going to actually lose money. Okay, so there's some of our drivers. And from when we examine the world like that, when we examine a particular market like the Australian market, and then we also can examine individual sectors using exactly those sort of drivers, we come up with certain themes. Come from a musical family, so always like to see if they make beautiful music. Not always, they don't always. But what I do want to leave with you, these are the themes. If you can see this in some other stocks, then I think you're more than likely going to make money. The most important thing at this particular moment in time is if growth is hard to find, growth will be valued the most. So if you can find a company that's got a visible path to growth, that company's PE or rating is more than likely going to be sustained in this market or even get bigger, even in the context of maybe this PE for the entire market going sideways or down. So you want growth. Because we're into an environment of volatility, you don't want to be exposed to a very leveraged balance sheet. If you've got too much debt, and if the world wants to be a little bit less on growth for a while, China's worse, maybe EU gets worse, then you don't want to be out into markets seeking money at the wrong time. So you want to have a good balance sheet. Very important in that same context is a competitive position. In other words, is the business any good relative to its competitors? So it always still comes back to running a good business when you're picking stocks. Capital management potential refers to, I've got too much capital, should I pay out a higher dividend rate or give back a capital return? And we've had a theme of this year, and we've had a very successful track record in picking companies that have had very good capital returns, including Suncorp, for example, as one, and Wesfarmers as another. But we'll talk about Wesfarmers in a little bit more detail. So what I've mentioned in my talk so far is liquidity has been strong. The PE or the ratings have been strong till now. Earnings have been almost exclusively driven in Australia by reducing costs and the cost of finance going down. But what we want is revenue growth. So I've become even more particular now. Earnings growth, not from anything, but from top line growth. Can I sell more widgets? Can I do more services that will be accepted by the marketplace? And can be priced in Australian dollars in the appropriate way. So we're now talking about revenue growth here. So that's that. And that's the next phase that we want to be looking for. I'm not saying the whole market can do that, but individual stocks that can do that will be rated more highly. So I just wanted to mention that the Australian economy is in a state of change. And here, these are capital expenditure from the mining industry and the non-mining industry and the intentions. So you can see the mining industry came up from a small number to a much, much bigger number over the last 20 years. But the intentions are to go down. This is one of the big changes that will happen over the Australian stock market. The non-mining sector, which went up and has gone sideways for quite a few years, really a decade, is now starting to come up and will need to go up. There's a lot of expenditures that have been put off. So I think of a company like Horizon. Horizon, you may have heard of it, was called Queensland Rail, and it was the privatised part of the Queensland government's coal rail network. And they also have some iron ore carriage in Western Australia. Now, they're going to spend $250 million on an IT system because they've just got to. It's so old, and that's the sort of capital expenditure which has been held back by these companies trying to reduce their costs and keep their shareholders happy with extra dividends. Well, good, that's good, but eventually you've got to start to spend. So we think that the capital side is going to be positive in Australia. It might take 6 months, it might take 12, but it's going to be positive in my view. The other thing is the business conditions. This little line here has gone positive, and a bigger positive than we've seen for quite a few years. So business is now looking to say, I'm looking for revenue growth because I'm running out of cost reductions and I'm not going to get any cheaper finance. So I'm a managing director. I want to get paid. I want to keep my job. I've got to find growth. And that's what's going to drive the Australian market. And we're dropping things that we don't do well, and we're going to be pursuing things that we do well. Less waste, more gain. I'm very optimistic over the medium term. It's not this month. It's not next 6 months. And this is the time that you should be identifying the stocks that you want to be buying and accumulating them. So some of the portfolio themes, we put this in our monthly report. Do you want high dividend yield or do you want growth? Well, you want a mixture, but you want a little bit more growth. Industrials versus resources at the moment, the momentum is still negative for resources, so we're looking for industrials. But not just any industrial, you want a good franchise. In other words, a good competitive position. And at the moment, we're actually underweight banks because we think that they're relatively expensive and something is going to happen. It's very fundamental. It's something like as important as this. A bank has got leverage of 10, 12 to 1. If they're said, no, you can only have 9 or 10 or 11%, 11 to 1, that means they've got to have more capital for the amount of money that they can earn. So the earnings rate of banks in Australia in the future may tend to plateau as they need more capital as the international rules are imposed upon them. What's that? Exactly. And the Basel Treaty will be, and the Basel III Treaty amendments are extremely important. Do not ignore them. Well, they're not fully accepted in Australia and there's not the case being made. We have a financial inquiry run by the former managing director of the Commonwealth Bank who is doing that. Mr. Murray is engaged in this at the moment, and this has not been adopted yet. But for me, the risk is big enough to sort of say, if I can find the same sort of yields that the bank can get with a bit more growth, but I don't have that Damocles sword hanging upon me, then why take the risk when you do not have to? That's my view. I can be wrong on this, but there it is.
Can you give an example of the franchise industry?
I'll do so very shortly. If please bear with me, and I'll take you through one of those. Yeah. And the other theme that we've got is, do you want something with foreign and domestic earnings? For the moment, with the domestic economy being a bit sleepy, some foreign markets, particularly the US market and some of the service markets are doing quite well. You want foreign growth with a bit of momentum. So they're our themes. So we're looking for stocks that will fulfill those wonderful, lofty portfolio themes. So first one, well, I'll go to your question first, and it's a very good one. I'll start off with this one, Wesfarmers. Wesfarmers is a supermarket owner. You may have heard of Coles, and just looking at their revenue, earnings before interest and tax, Coles is this big portion there of their earnings. Bunnings is a hardware store. They are the #1 hardware store, and they are the competitive killers on the block here. As Woolworths, who is trying to establish with Lowe's from America a joint venture, they're losing hundreds of millions of dollars trying to build up their stores, and they may abandon that task. If they do abandon that, Bunnings gets to pick up their market share. So that's a potential upside that we haven't factored in. So I'm not saying it's going to happen. I'm just sort of saying that is an upside for Wesfarmers because of their super competitive position. That is their franchise, being competitive. They have a number of other stores, so that 82% of this company is retail, but it has other operations. Whereas the resources one is this, that's basically coal, and that's doing it tough. Coal prices are down. So their earnings are under-earning because of coal. The insurance business is one of the businesses that they picked up, and they've also partly sold, and they got excess capital. So they're going to give us back $1 a share because they've done a good business. This is a very entrepreneurial company. So this is good, but I believe this company is going to reinvest some of their capital in the financial services sector. Now, when I go to the supermarket, well, my wife does a lot of this, and my son, he's a very good cook, so he likes to choose his own ingredients. They go to Coles. They know everything about our family. They have the big data. With big data, you can do, and with lots of frequent transactions, they can get profile and also be able to introduce products. They've already started to do this in joint venture with some American operations. I believe the growth for Wesfarmers is not confined to retail, but it will be in financial services and opportunistic businesses that get thrown out at the bottom of the cycle. They've done this time and time again. This is a 100-year company of and it's of Western Australia's most successful business by far. So we have fundamental view that they're not only competitive, they've got fantastic balance sheets, so they're undergeared. They're going to give you back capital, so their capital management. They need the shareholders to approve it, and also the Australian Tax Office to work out the status of that $1 a share. When that happens, you'll get $1 a share back. So they're ticking all the boxes on these fundamental factors. People have pointed that, oh, it's a high PE, but it's actually under-earning in some of their operations, like fertiliser is where fertiliser you can use it for rural purposes or explosives. And the mining sector has gone a bit negative. So that's under-earning. These can earn more going into the future. And they've got this entrepreneurial aspect where they buy low, sell high, adding value along the way. This is the sort of business I want to be friendly with for a long time. And as the market, when you get periods of market weakness, you buy the quality stock that the market just sells down with all the rest, and this is one of those stocks. So the other way that we examine this is not just in, these are the fundamental factors that affect it longer term, but we also look at what is it looking relative to the stock market. And the red line is the earnings of Wesfarmers. Now, part of that earnings decline that we've had since the result was partly because they're going to give us back all this money. They've got less money to earn from, and partly that some of these segments were a little bit worse than people expected. But the blue line is the price earnings ratio of Wesfarmers divided by the price earnings ratio of the industrial market in general. So when it's high, it means Wesfarmers has got a big premium to the stock to the industrials general average PE. And when it's low, you really want to be buying it there and selling it there. That's the game. So what we found was the market started to re-rate Wesfarmers before the result, and they were a little bit disappointed. So you're buying it at least in the middle of the range, but towards the bottom of this relative PE range. So if this share price comes back even more, and it was nearly $43, I think it's a bit lower than that, as this stock price comes down, that's an opportunity. I spent a bit of time on this one, but this one does demonstrate the longer term factors. It's inherently good business, it's competitive, and it's well provisioned on the balance sheet side. It's going to give you good returns, and we believe that management know what the hell they're doing, and I've got a 100-year track record to prove it as well. And relative to the market, it's not expensive. It's not the cheapest it's been, but if you see weakness in that for whatever reason, that's one to possibly accumulate. I'll go back to an energy stock. Oil Search is a stock I've followed since 1983. Papua New Guinea is, I have a very soft spot for the Papua New Guinea. But I have even more respect for this company because this is a company that's gone from 50 cents to $9.50 and on the basis of pure growth. Pure growth of what? First of all, it was oil production, and they've been in production since the early 1990s in oil, and they did a lot of work to stop the oil fields from depleting because oil has only got so much in under the ground, and the more you produce, the less there's left. They've done a good job in that, adding value, but they invested in trying to get They're big gas discoveries which were not commercial because in the highlands of Papua New Guinea, I'm not sure if you've ever seen it, but it's extremely difficult territory. There are no roads up to the highlands until they built one last year. No roads, none. Extraordinary. There were some tracks, but this is an engineering feat of monumental proportions. Now, a very important thing has happened. Unlike me, which I've been waiting since 1983 to commercialise their gas discovery back in that time, they've already commercialised with an liquefied natural gas trains number 1 and 2 in April. Both trains have done something I've never seen before in the global LNG business, and they are both at full capacity as we speak. That is extraordinary. That means it's creating cash and cash flow on a monumental basis. Now they need that because net debt is quite large at $3 billion and nearly $4 billion. So that's net debt. But these blue bars here indicate you're going from negative cash flow to positive free cash flow. That's after capital expenditure. And then over time, your net debt to equity, which is high here, you want it to be low, will go down, 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 down. So what are the themes here? Well, first of all, you've got visible growth. You've got visible growth because you are here and it's going to go up like that. And they've got the potential to develop another LNG train in the highlands. Now, this one will come very cheap because you do not need to build another pipeline. There's room in the pipeline. You do not need to build at the LNG place more storage for LNG. There's enough storage. You do not need to build another jetty to fill up the tankers. That's all done. This is one of the cheapest developments of brownfield developments, of secondary development in the world today of LNG. So am I worried about the oil prices going down? Yeah, I am a bit. But if you are the most competitive, you're going to be developing your expansion before everybody else. The bankers love them. They'll get the finance. If you've got a marginal project, the bankers will not love you. We all know about bankers. You know my attitude. I've worked for banks. I know all about them. They don't love people that don't make money. So these guys will make money. This project will go ahead, and the way that we'll know that is after they do a little bit more drilling in their area. They could either find more gas underneath the existing gas field, or they'll prove up more gas further afield. But because it's very hilly, you want to test whether you've got gas underneath your feet before you can save yourself $1 billion. No, it's 1.3 billion US dollars if it's underneath your feet. So it's worth the wait. And Peter Botten, a person who is the managing director I've known for the past 30 years, and half of that has been with Oil Search. I say to Peter, you're doing the right thing from an analyst point of view. So it's got a lot of the themes. Growth, it's going to get better funding, and they're committed next year to improve their dividends, which have been very low. But the dividends will go up, and in fact, we may even get a capital return. So you'll get dividends, you'll get growth, you've got a competitive business so that if the oil price goes up and down, you're not sweating blood. If it goes down, maybe buy some more. So this is a great stock. Because they built 2 big LNG tanks, and when you make liquefied natural gas, you fill them up and you drain them as the tankers come up. So if you've got another LNG train, they fill up quicker. You just, instead of having a ship every 3 days, you have a ship every 2 days, and that's all you need. So that's the beauty of adding to production. Just like Rio Tinto adds to production at its iron ore mines, they actually get better margins the more production they make. Now, I'd like to discuss a sector in Australia that's possibly underappreciated by some, and it's the healthcare sector. We have some world-beating companies. I'll feature Sonic, but you might have heard of CSL, the blood products manufacturer. That is a world-class company. It's been one of our conviction key stocks in the past many times. This one was a little bit cheaper, and it's also got some opportunities, I think, right now that the market is not grasping. This is in health, which is a bit lower risk. You know, we're not going to not go to the doctor or get an image if we are sick. If you can afford it and you're sick, you're going to do it. So it's a good industry to have in less certain times of growth. So that's the first thing. It's defensive earnings, what we call. It's got a competitive model, particularly in pathology, where they take samples and will examine the samples to see, you know, what may be ailing you. And it's started in Australia, yet able to establish profitable businesses and expanding businesses in jurisdictions like the United States, Germany, and in the United Kingdom. And who knows, after next week might be Scotland as well. I have to say that separately, but maybe not, don't know. And other parts of the continent. New Zealand's a small business. They have medical imaging as well. That's only 11%. And they've got doctors' surgeries. It's only a small part. But the main expansion is in pathology, and the big opportunity that we see, which we do not believe that the market sees as much as us, is Germany. Why Germany? Germany have got a lot of pathology operations, many scattered all over the place. Germany is a very decentralized country. It's the way it was established after World War II, so that not everything was concentrated in just one city. It was the deliberate way that that whole society was organized after World War II. And it's had an impact in all sorts of things. And the health sector was one of them. But pathology, where you're sort of taking samples and you're examining them for what may be a disease or chemical composition of your blood, whether you've got traces for certain diseases. So it's an important part of the medical process. So that's the benefit. But overall, underlying all of this, there's a big and important theme, is that in wealthy countries like in the United States and Australia, increasingly in other places, you've got an aging population, and the demographics means that maybe you have to have more tests. So your business is getting bigger, and as I said, if you're not well, you would want to invest in yourself, because without having life, you can't enjoy the other things. So we think this is important. So that is one of the reasons why we think that this is a multi-year trend, and not necessarily dependent upon whether manufacturing growth goes up or down a little bit or not. So let's not worry about so much local growth or global growth. What do we have to worry about? Every stock has problems, and one of them is health budgets. So governments always want to reduce the health bill. So what you need to do is have a business that's becoming more bigger, got better scale, and has lower overall costs, so that you can deliver a dividend to the government by having lower charges that you charge the government for in certain health systems like in Australia, and yet maintain your profits or even still grow your profits. So you still have to be a very good manager. And if you're the number one in the business, it always helps. So that's a risk still. Is there competition? Yes, there always can be competition issues. But and whether, if you make a new acquisition, is it going to be a good acquisition or bad? They've got a track record of making good acquisitions. I'm sure that they'll make the odd bad one, but because they're so small, especially in Germany, a little one here, a bad one here or a bad one there, they'll learn from their errors. And to me, that's actually better. It makes their business better. but you're not going to destroy the capital base by making a little acquisition that goes bad. So we think overall this has got the good themes, but is it worth it relative in the market? So let's go back to the market. It's got a good record of earnings growth. This is the red line here. And the market got a little bit too enthusiastic towards the end, thinking that the earnings were going to be good, and they've actually brought them back. But what has happened to this relative rating of the market? Well, back here, the market thought it was a 25% premium to the market. It's, you know, it's pretty hot stuff. Good growth, knew what they're doing, yet over time, it's actually derated. Its growth has derated. Its PE has derated to under 10%. And in the last little while, not only did the earnings come down, that little bar came down a little bit further there. So you're almost paying the market multiple for something that's going to deliver quite good growth for fiscal year 16. Now, this company gave guidance which was a little bit disappointing, but this company tends to be conservative about its earnings. And then over time, usually, it outperforms its own guidance. So we believe that the growth picture is sound enough for this earnings growth to be exceeded. 5%, might be 7, 8, 9, 10%. If it beats estimates, the relative PE will go up, even if the earnings accretion is only a few percent. So just on that turnaround alone, you might make 8, 10, 12% plus dividend yield. And the dividend yield is about 4%, 4.2%. And it's got some franking attached to it as well. So that is a good overall picture. It's not the highest risk, highest return play. It's more of what we think is the lower risk, but a good portfolio stock to add to your overall exposure to the Australian market. And you're not relatively paying ridiculous prices compared to history. You're paying good prices relative to history. We like that. Now, here's a stock which is a retailer that relies a little bit more on the economy, right? So this is a bit higher risk, but not the highest risk in the stock market. It's got a competitive model. These are great electronics and entertainment retailers that have done a good job, a very, very good job. The share price is about $17, slightly lower, I think, on Friday. This stock used to be priced at $1. So these guys know what the hell they're doing. Absolutely. This is their store numbers. But you'll notice there that there's these green stores. And what they've been doing is been converting some of their entertainment and electronics stores into homeware stores. So it's a lot more things that fill up your home. And they're now getting a big enough footprint to get a lot of economies of scale. Now, with interest rates being so low in Australia, housing has been doing quite well, and we anticipate that housing will continue to do well. And there's two reasons. I sort of experienced this myself a bit. I have a 26-year-old son, and he lives at home. I love him being at home because he's such a good cook. Right? This is a great thing. It would be a great sadness for me to leave. But I know that there are many of my friends have children that are still at home but cannot afford to move out. So if the property market wants to go sideways for a little while or even go down, there's a huge, absolute huge number of people that want to form their own households in units or houses in Australia. And this will be a long-lived event. And this is going to capitalise upon that new formation. On top of that, Australian population growth is stronger than almost any other OECD country out there. So we've got strong population growth. It's about 1.3%, roughly. It varies from quarter to quarter with net migration. That's the big swing factor. But Australian women have children. Japanese women seem to forget about this. Italian women seem to forget about this. And of course in China, the demographics in China are extraordinary, as in very low replacement rates. So many of the features that we see here will be features that you'll see in China for those demographic features. And one of the big plays for that will be CSL, the blood products manufacturer. Also in our model portfolio, I haven't featured it here today because we had a great success with that recently. The share price went up a lot after the result. We believed in it, and it was a focus stock, and it went up a lot. But we're sort of saying it's going to go sideways for a little bit now. But that's another one to look at. So this is going to pick up on some new trends with this green stores. They do a competent job here. Earnings growth is about 5 or 6%, but we believe that that underestimates what could be happening in the Australian economy a year out. But there is a little bit more risk attached to this. So weak growth could be the risk. Increased competition? Yeah, always. But they've always dealt with that quite well. And a rapid fall in the Australian dollar changes their pricing and costings and stuff like that. So we're getting a little bit of that. So, but let's look at the relative price earnings. It's a bit more of a roller coaster earnings here. They were high and then went down and then have been building up, a little tiny downward move there. But the relative PE has gone from a premium of 10 or more % to a discount of about 15%. That's a 25% relative move. That's a big move in a quality retailer, and that now starts to open up the opportunity. So yes, not all the questions are answered, but the market has made it a lot cheaper, and that is possibly worthy of your consideration if you're happy to take on the risks that are involved. And the final one of these, what we call conviction stocks that I want to talk about today, before I get on to some small capitalisation stocks and maybe some contrarian stocks, is Boral. Oops, sorry, it went too far there. Boral is a building supply manufacturer, and in construction materials, they have got something that you really want. They've got mines, not iron ore mines, they've got quarries. And the thing about quarries are they've got to be close to where the rock is used. And they're close to big centres like Sydney, Melbourne and other urban centres. So that's the bedrock of their franchise, their competitive aspect. They have other aspects which make them competitive. But the earnings, as you can see, are again quite volatile, and the reason is when the economy is down, earnings are down. When the economy is up, earnings up. So, you know, we need housing's doing quite well, but other parts of non-residential construction and investment are still yet to pick up. But something interesting has happened over the last few months, and the relative rating of this company, people were expecting a rise in earnings. So it went from a 10% premium to a 50% premium to the market's industrials PE. And then when we got some of that, it says, all right, that's enough. And then same thing here, a bit of anticipation, yet it's now corrected back to here. The market's suggesting that this thing should be only earning a little bit more over time. We think that that earnings rate is going to be a lot higher. So the market's pricing it on peak earnings when we think peak earnings are way up here. And you're going to get the element of this going up over time. They have a US operation, which US is ahead of the game in terms of the economy picking up, and that's been losing money in recent times, but the losses are getting a lot smaller. We're anticipating that those losses will go to profits. So something that's been dragging the the group down, will turn it into something that's positive. And they've gone into a new gypsum joint venture with another party, which will increase efficiencies and get some of the cost benefits independent of the economy. So big tick there. US is going to be a bit better, and construction materials we think has got non-residential and other investment upside when those intentions turn into actual turning of ground. The final thing that makes me confident about this is that in Australia we've had a new government elected a year ago, and there's been a lot of problems with the Senate and all that sort of stuff. And the interesting thing is that once we get through this budget process, they're going to start concentrating on the infrastructure renewal project. This is going to be the biggest program on roads that we have seen. Who is one of the primary beneficiaries? Who's got the gravel? Who's got the bitumen? Who's got the things that will go into this? That's this company. And they're well placed to do it in each one of those jurisdictions. And that's the upside that makes us confident that this red line will continue to go up, and maybe this blue line goes up as well. You get a double whammy on the upside, but it comes with a few bumps along the way. So a little bit more risk, but we think this one is worthy of participation in a portfolio. This is not a portfolio of one. This is a portfolio of one of 5, 6 or 10 stocks, not just a sole participant. So they're our conviction stocks that I wanted to talk to today. Sometimes the small capitalisation stocks are the ones that in the right circumstance can be actually ones that rise much quicker than big capitalisation stocks. I want to talk to you about a small stock. It's called Credit Corporation. It's only capitalised in the Australian market about $450 million. What does it do? It buys receivable books or debt books from businesses and from other financial organisations and goes out to try and collect at a greater rate than they would otherwise do. So it's all about collections and doing it efficiently. They've been doing that, and they've got a great reputation in the Australian market for that, and they also are now extending debt itself directly to consumers. And this is a business which is underappreciated by the market. There's only a few analysts, and my colleague Ken Wagner has been following this company for a long time. He's one of the best analysts on this company, and people do not appreciate that this consumer loan business, with the guidance that they've given us, could be in 3 years 60% of the current earnings could come from the little division there. So it's a growth. If you're looking for visible growth in a market that might grow, might not grow, but that's a business that's going places. And it's a small business, so there are always things that can go wrong. So you need to have the potential for a high returns over the risk that you're taking. So what are those risks? Well, number one, you could have competition buying these books. Now, there's a little bit of competition that occurs, particularly in the United States. They've got a division there that's really just breaking even. It's a big market, but in America, capital is freely available because of the central bank policies. So it's a bit tougher for them. They found it tougher to grow than they otherwise should have. But that may change over time. The consumer lending business is on the up, but it's still small, but it's growing quickly, and the core business is doing okay. Earnings per share growth, 12, look at this, 20%, as this business starts to really hit its stride. And these are one of these underappreciated markets. So yes, comes with risk. Is it relatively cheap? Well, in the past, it used to be at a big discount to the market, and then the market saw, oh look, earnings tend to go up here, and then they priced it at the market multiple. For a small capitalisation stock to be priced at the market multiple says, gee, that's pretty good. But since then, it's actually derated. not by 5%, 10%, but it's actually derated about 25%. So you're actually buying it relatively cheap, and it's got growth, but it's a small cap company. So if you're willing to take on that little bit of extra risk, it's got all these things, all those themes, the growing franchise, it's got efficiency as it builds on these businesses, but it does face a little bit of competition. That is our small cap pick on the industrial side. Sorry? Yeah, look, there's not a great understanding of this business in the marketplace, and really, we found it quite difficult to explain, and that's why we find this as an opportunity. It is a difficult business to understand, and many people do not really grasp and they think, oh well, these debt books are never going to be around, or there's too much competition to get them. I know as business expands, there's more debt books, and the last thing that many businesses want to do is go collecting for their money, as opposed to getting on and doing what they're good at, being a good service provider, like a medical profession, a dental surgery or group, or a manufacturer. The last thing you want to be doing is chasing your bills. You want cash flow, these guys can give it to you. So we think it's an opportunity. Yeah, that's the way it's classified in the Australian sphere, because it's a service. It's a financial service, but it's a type of... Look, don't blame Australia. Australia took on the S&P rating system for global things. This would be, if this was in the United States market, it'll be in this exactly the same subsector of the industrial market. But it's actually a financial services operation. I do agree with you on that. Look, it's at the bottom of the GFC, it was probably poor, but poor is good for these guys. So there's more opportunity. Most businesses would want cash flow even more in that instance. So you'd probably have more books available to you. So, but as business expands, also your debt receivables also expand. So it tends to be a lot less up and down than the economic cycle. Another reason why we like it. Just very quickly, and I know that time is of the essence, so I'll move on to a resource theme pick, and this is Cooper Energy. This is a very small capitalized company, $150 million, and this is what happens. This is a very well managed group. The managing director I've known, who's ex-Woodside Petroleum. I was on the help manage the aspects of the Woodside Superannuation Fund, actually, and that's where I got to know him. But he was in gas commercialization. What's a gas man running an oil company doing? Well, this is a really important question, and this is the future of this company. At the moment, Cooper Energy produces 90% of its oil from the Cooper Basin, and it's all oil production, a little bit from South Sumatra as well. That's growing, but it's a small operation at the moment. What they want to do, they're profitable. They made record profit last year of $25 million, but they've got small reserve base, only 2 million barrels, 2 million barrels, and they do drilling to keep it basically 2 million barrels all the time. They're doing some more drilling that might make it 3 million barrels in 12 to 18 months, but that's good. You know, it keeps the company ticking over, but it's not going to transform the company. But what has it done to make the company a completely different company? In the past, they drilled in Tunisia, offshore Tunisia, and found a big oil field, and they've got not 2 million barrels, but more like 17 million barrels of resource there. That's not yet commercialized, and what they're doing is they want to actually sell that to work on this gas commercialisation strategy. So the direct strength of this managing director. And what they want to do is explore. They've been exploring for gas in the Otway Basin. They've found some, but they haven't got the full breakthrough there. And they also purchased a gas field offshore Gippsland Basin. It's offshore Victoria. There's Melbourne. This is where BHP and Esso or Exxon have been producing from Australia for a long time. And they purchased this gas field. I call it a gas field. It used to be an oil field, and the oil wasn't coming out at the right rate, and they had to abandon the project. So all the wells, almost all the wells that they need are there and operational. They need to be recompleted higher in the gas zone. And with gas prices in Australia moving from $3 to $4 to $5 per gigajoule, they're going to be potentially $8 and $9 a gigajoule. So the gas that was uncommercial before becomes commercial, and that is what they're trying to do. They bought this field for $1 million, a single $1 million, and that's the resource that they've got from it. So what they want to do is get in partners after they complete their study early next year, get partners to help them develop their share of that. And in other words, use other people's money. But this company doesn't even have any debt. It's actually got $75 million of cash itself and investments. Some of those investments are to buy additional things, but they're all secrets. They won't tell me. Yeah, David Maxwell's a great friend of mine, but he doesn't confide in everything with me. So as it should be. Anyway, so they can convert some of that into development of that, and also sell part of that to other people, so that you're less out of pocket and you get the value of that. So that's the big upside. But in the meantime, this oil unit here, which is highly profitable, it's got good margins, continues to pay for all of its costs, and also enables that to grow a bit, to do a little bit more extra there, and yet leaves this piggy bank here and the potential to sell that to develop a brand new project. And that will give it growth out to 2018 to 2020. Again, small capitalisation stock, so it comes with a lot of risks. And, you know, what are the other risks? That you have things that break down and they don't get cash flow. So oil wells can get clogged up, etc. But and of course, oil prices can come down, and they have come down a little bit. I think that this, as a small capitalisation stock, with the risks attendant to it, could be an interesting one for an extra part of your portfolio, and probably with a mind to trade it as well. And that's where you need your close consultation with your advisor. So they're two small capitalisation stocks. I want to talk to you about big picture stuff. Now, when I do a commodity analysis, I try to get, like that roadmap at the beginning, you know, what's happened over the longer term. I like to look at commodity prices over the long term as well as the short term. And I'm going to let you in on a little secret here. It is extraordinary. This is an extraordinary story. Back in the year, just on the year 2000, 1999, was the lowest real price for commodities in the history of mankind. The price of metals were the lowest they'd ever been. And we had a boom. Oops. Ooh, geez. Go back. We had a boom. Now, China was the reason for this boom, but we also had other things going wrong. The cost of extraction of oil was going up. The cost of extraction of things like copper was going up. So there was cost push, but also demand pull. But not all commodities performed the same way. Extraordinary. So let's look at iron ore. Iron ore is the red line. Yeah, it was doing exactly what the other ones were doing. You can't find it in there. Yet it went up 9 times. And even with it coming down, it's still relatively expensive from where it was. Now, the costs are higher You've got to take that into account. But in essence, it's still reasonably high. Let's look at oil. Oil is Brent in green, Brent oil, and it's sort of come up a lot. It's 4 times from where it was. Copper, almost identical. But coal, which did very well early, particularly coking coal, did very well early in the China boom, is now down to 3, and basically at the cost of production. So I don't see much downside for hard coking coal. There might be a bit, and it might last 6 months, might even last 12 months. But on a long-term basis, this is cheap relative to oil and to copper, and a lot cheaper than iron ore. Same thing for thermal coal. That's power coal that goes into making electricity. It's very cheap, and the costs have come up. But look at this, aluminium. You know, like a snail, it went up a little bit, then went down. What happened? What happened? Aluminium is made up of a thing called bauxite. In the ground, it looks red, and it's sometimes like little balls, and it's just dirt. And then what you do, you take that dirt and you put it in a big chemical factory, and it cooks it up under pressure, and it breaks it out, takes out the red dirt, which is actually mostly iron, believe it or not, and clay, and silica, and then leaves you with aluminium oxide. It's like a white powder, and it's used in swimming pool products and stuff like that, and abrasives. But the main use for alumina is for making aluminium. So you take that powder, that white powder, and you put it into a big bath, and you plug in a big electricity anode and cathode, and you zap it with the electricity, and then the oxygen separates from the aluminium, and it becomes metal, and the oxygen goes away. So that is the process. Now, a lot of that process is very capital intensive. And what does China do very well? They're very good at making manufacturing plants. So aluminium is a big manufacturing plant. They reduce the cost of building these aluminium plants by 2/3, roughly. And they also supported it with cheap money. So cheap finance, reduced the capital cost. They built a lot of these plants. But what they didn't do was go into the earth and create all these new bauxite deposits. The earth gives you what the earth has got. You can find some more, and they've exploited those to the maximum. And what they did, what some manufacturers of aluminium and alumina did, was to import ore from Australia, Indonesia, and other places, the Philippines. But Indonesia said, no, we want that for ourselves. We want to create our own alumina and aluminium business. And this will continue. And this is the future of this. But it will take a long time. In the meantime, they say, no, you can't have most of that bauxite. So the costs of aluminium are going to go up. And this has already started moving up. This has got a long way to go. The price of power, cost, all those costs have gone up. Aluminium has not made much money. How is this relevant? Well, it's relevant to Rio Tinto. Everyone thinks about iron ore, and it is important. Iron ore is important to Rio Tinto. It's 49% of the last half year earnings before interest and tax and depreciation. So it's important. The iron ore price goes down, it goes down. But what has it got? It is competitive. It's got the world class. It is the lowest cost mass producer of iron ore on this planet. And when the price goes down and other people go broke, that means this guy, Rio Tinto, Vale in Brazil, the old CVRD, and BHP, they all are going to end up with more market share. And that's what this is all about. So in the short term, pain, no doubt. No doubt there is pain. But long term, stability, and they've got their own franchise. This meets one of our basic tests. that it's got a franchise and competitive business on this bit. But what does this company have that's maybe different to, say, BHP? Well, it's got a big aluminium division. 22% of earnings, these are depressed earnings. This is on this pricing, not this pricing, this pricing. When this pricing goes up a bit, this goes not 22, but maybe 32. They're in bauxite, and they are increasing their exports of bauxite. They're in alumina, and they're also in primary metal. And they're in all three, and all three are leveraged to prices going up. The bauxite price is now starting to move up and will continue to move up, I believe, over the next 2 or 3 years. They'll make some good money out of that. That'll add a few percent. So 22 might go to 24 or 25%. But the aluminium metal price, if that goes up, even 20%, then you're going to make a hell of a lot more profits from all of that. So I'm confident that this can expand, albeit at a time when iron ore might be struggling. But longer term, the iron ore business is in their hands, the big three. I like businesses that have got big players that control the market. So that's a contrarian play when everyone says, oh, you've got to sell iron ore stocks. Well, it's true. We've not purchased a single small cap iron ore stock for over a year now, for a good reason, because we were expecting this to occur. And when their margins go down to zero, they make no money. Rio Tinto makes money today and will make money even if the iron ore price falls another $10 a tonne, $15 a tonne. So then finally, so that's one contrarian play. That's an aluminium play that's hiding behind an iron ore play. The next one is Whitehaven Coal, and this is a thermal and metallurgical coal. That's a coking coal. And what does it have? It's got growth. They're just in the process of digging their new mine called Maules Creek. Maules Creek, that's this bit here. And this mine is an underground mine, the Narrabri mine. They got to full production. In fact, they're going to get bigger than their nameplate production, and their costs have come down because of that. Now, I'm going to show you something about the way I approach on a strategic basis. This is not good for the trader day to day, but strategically, why is thermal coal used in the world? What's so special about thermal coal? On an energy basis, if I can compare it to oil, now Brent is in red here, that's the Brent oil price. It's been coming down recently. It's just a bit under $100 now. This is the Australian thermal coal export price. It's been coming down a lot. The green line is the percentage of energy value of thermal coal compared to oil. And about 8 weeks ago, the coal price in energy terms compared to the oil price was the lowest it had been. So you're buying the thermal coal price today relative to oil at the cheapest price. So the old man told me about investing. He says, you've got to buy cheap things and you sell them when they're expensive. This is cheap. Thermal coal is cheap. Thermal coal will be used in the developing nations to expand their footprint. And I'm thinking about Indonesia here. I have got the greatest confidence in this country, in its development. Indonesia, along with India, in combination with a couple of other countries in our region here, in our greater region here, will be as important as China has been, and will have a longer duration of benefit as well, because they don't have that demographic issue. So, and there's diversity in their societies and their economic base. So I'm going to see, we're all going to see a lot more of Indonesian thermal coal going into their own plants to make electricity, to build their own industries like the aluminium business and the alumina business. And pollution will be a problem, but I will give you this other thing. I'm as green as the next person, but I have different ways of doing this. If we start to use higher quality coal for every gigawatt of electricity that we produce. If we use better quality coal, we have a much lower carbon emission footprint. So the higher quality coal will come with a better price attached to it because it will emit a lot less pollutants. And this company's coal is going to be, it's actually quite good on average, but will become even better with this mine. So there's a quality as well as a quantity aspect to this company, and also the operating costs are going to go down. Quality up, that means your prices, whatever the relative price of coal is going to be, you're going to get a slightly higher price than you otherwise would. Your costs are going to be slightly lower than they otherwise would, and if the market does turn, you're going to be leveraged. Now, this company is high risk. It made losses last year. We're thinking it's going to make a loss this year. So, but when it turns and this becomes fully in operation, the profits could be immense. So instead of a PE of, many of the market is 15, it could be on a PE of 5 or 6. Now, I might value this more. The stock market might value this more, but it might be taken away from us because this is an important tier 1 asset. It's a good quality asset for a mining company to own. It might be taken over. In the meantime, you'll get the benefit of that uplift in valuation. So again, this is probably amongst the highest risk stock that I've presented here today, but you can sort of see the leverage that it's involved. It picks up some of these themes. It does have risks. The $8 coming down is very positive for it, but the coal price needs to start going up before we get into profitability for this year. And next year and the year after, then it will become easier to get that profitability because the good quality mine will be producing. So I've presented a range of companies today which are moderate risk or low risk, right through to much higher risk, and they're higher risk because there might be small capitalizations or are not making money at the moment but have got enormous potential. So I certainly would be welcoming of any questions that you may have in addition. I'll put up some slides. Our model portfolio shows you the range of sort of companies that we have. These are the more up and down sectors, cyclical sectors. Oil Search we talked about before. We like Santos as well. Rio Tinto is our #1 stock in resources. These are much more tiny positions in comparison to Rio. Boral is there, we talked about. Brambles is an overseas stock and big beneficiary of the Australian dollar falling. Big beneficiary, just like the resource stocks. Credit Corp is there. Seek is an employment. We've got a couple of infrastructure stocks, Sydney Airport. Transurban is our motorways thing, but they're a bit expensive at the moment, but they do give us yield as opposed to growth. What's it? Brambles, they have a thing called returnable pallets, and goods are piled on pallets to help forklifts move them around. And you think that's not much, but it's use and reuse, and managing that in a big enough stockpile in the United States, in Australia, in Europe. Europe is slow. US picking up. We like that. So that's our cyclical stocks, and then very quickly some of our more defensive stocks. The healthcare ones that we mentioned before. There's Sonic Healthcare, Ramsay, and CSL. These are world-beating companies, these two here, and Sonic, I believe, can join them as one of the core constituencies of Australian expertise that has gone global and will continue to go global. There are other ones like ResMed, you may have heard, for respiratory ailments for sleeping, and there are others. Here we talked about Wesfarmers. We've got Woolworths as an underweight, but it helps us with a little bit of yield here. But that is a source of funds. Telstra in the future is a source of funds because very reliant upon dividend yield, and growth is fairly small, although it has ticked up a little bit recently. And there come acquisition. They're going to be buying things in Asia, but everyone else wants to buy in Asia too. So I say good luck to them, but we're not banking a lot on that. And in the property group, again, it's about yield. We've got a little bit in shopping centres and got a little bit in Westfield, beneficiary of Australian dollar coming down. And then finally, here's our banks. We've got National Australia Bank. I married into a Scottish family, so I understand how recalcitrant they can be. However, I think the fears are somewhat overblown. That said, this company's got the best yield, and if I'm going to use scarce dollars, I may as well get paid for it. And then finally, we've got a big thing in Australia called wealth management. Again, as people like myself go, I'm the tail end of the baby boomers. I would like to retire. I need wealth managers to help me manage my money when I'm and I'm in that business too. So IOOF and Perpetual are our big plays. Macquarie, we've been bringing back a little bit. We're concerned on certain aspects there, but that has been a huge winner for our portfolio, both in portfolio returns and the like. So that's our model portfolio. This is available in our monthly document, which we publish, and we also talk about some of the changes that we make, so you're fully up to date as to what we're thinking about this portfolio, and we talk about those drivers, so that helps you make the decision about what sort of risk profile you want and whether you want to participate more or less in individual stocks. I'll leave those up on the board to give you a bit of an idea where we're at. PEs of the industrials are at a new post-crash high, so that's caution, but they're coming back in the last week. This is our commodity price forecasts. This is copper. This one's hard coking coal, so we're here and we're looking to come up. So I've got that coming up over time. Gold. Gold is a semi-financial asset, and as US interest rates goes up and global growth goes up, the need for gold goes down. We don't see much joy there. It might go up a little bit on geopolitical concerns, but gold is not featuring so much in our portfolio. Oil, we think, is sideways. It's well supplied in the market, but it's also got downside support. If the oil price fell to $75 in America, then with the shale revolution, the costs will mean I'm not going to invest my money in that. It becomes a rational market, not an irrational market run by OPEC. Saudi will cut back as well, because they can't afford $75, because they will have a revolution on their hand, because their budget is already in deficit, and they have paid off their population through all sorts of programs. They cannot afford 75 continuous dollars a barrel. So I'm very confident that the oil price is not a $60 or so a barrel, but I think it's well supplied enough to mean it'll be $95 to $100, something like that. So
That's good for the economy.
that's what?
Good for economy.
It is good for the economy. In fact, it's another reason why international growth and services growth is a little bit more in our liking, and for retail as well. Retail, Sept pallets, which is Brambles, they're a beneficiary. It's a wonderful thing. The healthcare business internationally, a beneficiary, and Australia has got some of the world-beating companies in that, and they're in our portfolio. So, and then finally, this is the prices of iron ore coming down, which we've discussed already. Thermal coal price, I thought it was stabilising, came down a little bit more, so that opportunity is even cheaper than before. And then finally, something on the technical aspects. So I did this a little while ago, but and you'll see it in our monthly report. This is the ASX 200. It was going up and up and up, and we said, look, it's got to test this line and potentially test this line. It tested it about 555 that's 5,555 on the ASX 200 index. It tested it, bounced off. It tested again, went through in the last 2 days. So it's going to be in this trading range. Now, the one thing I will say about this is this does not mean it's a bear market in the Australian market. It means that we're going to be in a consolidation pattern potentially, unless it breaks those two lines, that red line and that line. And if it's below the 5,400, then we have to think again. But while it's in between there, that could be an accumulate for our market. And that can go, accumulation could be 5 months, 3 months, 6 months. But I think ultimately my view about answering the question of whether we're going to have a very bad market or a very good market, I think we're going to have a tough market with increased volatility for the next 3 months or so, maybe towards the end of the year. We're going through a bad seasonal period. This is the worst seasonal period for volatility. So volatility should be part of your portfolio. But I think once we get through this part, I think the world in 2015 will be a slightly better place for equities and from a growth perspective. And if you're picking the right ones, we're going to be back on the ascendancy up here. Not going up like that. I'm sort of saying that sort of, but over a period of time. That's over a 12-month period of time. So you use this period of uncertainty and weakness to pick up the best quality stocks first. And then you build your portfolio from that. That's all the slides that I wanted to present today. There's a disclaimer there.